Hi, and welcome to the award-winning Ed Brown Show. I'm your host, Kamaria Richmond, and we have another great show for you today. We are talking to Mr. Aaron Simmons, and this is our second segment. He is a loan officer, and he is giving us a lot of information. So, welcome back to the show.
Glad to be here, glad to be here.
And let me start first, the name of your company.
First Heritage Mortgage.
Okay, First Heritage Mortgage. And so I wanted to start with the housing. So we had the crash, you know, in 2008.
Seems so long ago now.
It does, it does. So what happened where people actually went through that? They had to experience that.
Well, unfortunately, a lot of it had to do with some mortgage products that are no longer in the market. At that time, when things were starting, people had the real bright idea, and I always say it was a really aggressive idea, but the attempt to make a large portion of Americans homeowners, which means that sometimes you have to get creative, which means they started to put a lot of what we call Alt-A products. So you had 2-year ARMs and you had 5 years, and what an ARM is it's an adjustable rate mortgage. A lot of loans had a balloon product, which means that if you think about a balloon, when you put a pin in it, what does it do? It pops. Right. The adjustable rate mortgage, similar concept, so your rate would be fixed for a 2 to a 5 year period of time, but after that, depending on the index that it was based on, typically during that time, the rates were adjusting. So you had people that were buying houses for $300,000 and their mortgage payment, let's say that it might have been $1,700 for the first 3 years. But when that loan adjusted and the market and real estate values went down, they can't refinance the property. And so now all of a sudden you have a mortgage that went from $1,700 to $2,500. 99% of people can't afford those mortgages, and it didn't have to be everyone, but even 20 to 25% of the market, which is what it was at that time, that totally caused the crash. Values went down, and now I think we started to recover a lot quicker than what people thought, but now we're just in full uptake mode, and the market is really doing well at this point.
So do we ever see that again? Because now, you know, we're more savvy.
Yeah.
You know, everybody's more savvy. And so you never want to see the market like crash. But is it possible that something like that could happen?
I think one of the great things that the Consumer Finance Protection Bureau did under former President Obama was that when that was instituted, they eliminated almost all of those mortgage products that we were talking about. So some of those balloons, ARMs, I think people need to realize during that time, someone could get a mortgage not showing any income or assets, not having a job at all, and you could do 100% financing. So all those products that caused the crash, they're no longer in the market. Now you still have a couple of Alt-A lenders, but you don't have the major banks participating in that anymore, which is a huge, huge factor. So can things happen again? Obviously, this is an economy. We've seen stock markets crash within the last couple of years, and we've seen all of a sudden they have record highs. So if people have the economic and try to develop the economic savvy to say, hey, these things are going to happen. One thing I love to talk about is buying real estate, not retail. So you ever thought about when people try to buy cars, what's the first thing you want to do? Well, you don't want to buy a brand new car because it does what? It depreciates the moment you drive it off the lot. Real estate, you want to look for the best deal because the cash is made when you purchase it, not on the back end, finding the best possible deal. And the good thing now is that we have an interest rate market that's really, really strong. Rates are at record lows at this particular point. So it makes some of these properties that you and I were discussing earlier with the higher price points much more affordable for certain families. And obviously rates have to stay pretty low in order to afford $500,000 and $600,000 homes in this particular market. So to answer your question, I don't necessarily see that happening. The economy is really, really strong, but hey, anything is possible. And if I could give you an accurate prediction, I'd be in Hawaii somewhere.
Right.
So.
Yes, definitely. And so tell us about people that flip homes, because really during that time, if you were doing that in 2008, then you were you were kind of suffering.
Yeah, well, a lot of investors, if you talk to them now, some of those same investors that lost a lot of their properties at that particular time are back in the market. The opportunity really was, and I saw this firsthand from a personal standpoint and from other of my friends that are investors, is that a lot of people, when the market started to crash, some people lost their homes, but some investors were waiting on the sidelines, and guess what they were waiting to do? They were waiting for those properties to depreciate so they could do what? buy real estate at a discount. And so now that they got those foreclosures and they bought some of those properties that people lost, those properties have jumped up in value. So it's just the patience game. And a lot of consumers and homeowners, we have to start thinking like savvy investors. I think that messes us up a little bit because we're just thinking about it as, hey, I'm owning my home. But no, try to do your best to think about it as an investor from that particular standpoint as well. So when markets do crash, you want to be the one that has the cash to take advantage of some of those opportunities. It's the same thing if you watch the stock market. When certain stocks go down, sometimes you might say, hey, this particular person bought a ton of that stock. Well, is Coca-Cola going to stay $2 or $3? I'm just using it hypothetically. Forever, those companies always have some sort of recovery period. And so thinking like an investor and doing your research, it definitely gives you an opportunity to build wealth for yourself and your family.
So if I want to flip houses, because I never really get this, because you're going to buy the house, you're going to fix it up, and then you're going to sell it.
Right.
So kind of tell us about that process.
I'm not necessarily a house flipper. What I actually do is I help people facilitate the mortgages necessarily if they want to flip a person out or get the financing and things of that nature. But I can definitely tell you that's a huge market, and there are definitely some great professionals that you could have here that I could recommend to you, and we could definitely have them on the show, and we could do a little group roundtable maybe.
Yeah,
absolutely.
Because a lot of people do that, but let's say at that time when you were trying to flip a house between 2008 and 2010, I mean, what was happening? It was
just a difficult period of time. I mean, values were just totally plummeting. So sometimes those individuals, maybe they were doing what's buy and hold. So they were purchasing those properties at a discount rate and maybe waiting 2 or 3 years. And then once the market appreciated, economy got a little better, they were then trying to turn around and sell those houses. But I'm glad you brought that up, because that also goes back to the key of what I said earlier, which is you make money on buying the house at a discount. That's where the cash is made up front. Because think about it, if you buy something at the top of the market, you can't turn around and flip anything at the top of a market. So if you're actually looking to get into that particular business, which a lot of people are, and it's a very lucrative business if you know it, you're always looking for what? The deal, as with anything.
Right.
Buy low, sell high. It's the year-old principle that seems to never go out of style.
It doesn't. And so I wanted to talk to you about that, because now where we are with home prices, so we were talking before we started, so you could buy a home, like my mother was telling you in 1967, a home for like $19,000.
Isn't that incredible?
Isn't that now, I mean, someone's mortgage is almost twice that.
Absolutely.
So how did we get from the $19,000 to now a lot of these homes are at least 500,000.
Absolutely.
But a lot of them are going into the millions. And I know when I was first looking for a home, I saw all these great homes, and they were like almost $1 million.
Right.
And then the more I kept looking and looking, all of a sudden, that house was like $500,000.
Right. Isn't it incredible?
I was like, wait a minute.
I think the word we use is economics. You couple inflation with the rising incomes. I mean, it's great talking to your mom. She's such a wonderful lady. But think about the incomes that people were making in 1968, and then think about the incomes now. So with inflation, rising incomes, and just the overall economy getting stronger, the power of a dollar, and then also supply and demand. I tell people this particular area, even as a lender, is a gift and a curse, because we're in the DMV area. People have to remember the average home price in the United States of America, and I could be totally off, but I think it's like $190, anywhere between $190 and maybe $225,000. The average home price in this particular area, it might be $300,000 to $400,000. Those are two totally different plateaus, two totally different income levels. So those are things that we really have to think about. We are very, very blessed to be in this particular area. We have super appreciation. We have a strong job market. Everybody's getting excited about Amazon. I think you and I were discussing. We're not excited about the traffic. So, and you have the federal government, you have the Pentagon, you have contractors. So it's always going to keep this real estate market. But what does that do? That also affects affordability, which is certain things that people need to think about in the future when they're planning and developing.
So when we are planning and developing, what are the questions that we should be asking ourselves before we even get to the lender? What are the questions we should be asking ourselves?
Those are really, really great questions. And even a mortgage advisor is going to actually maybe ask you a few of those questions specifically. What's your long-term goal? Specifically, how long do you plan to be in this particular area? Is this your, you don't know how many times I hear somebody say, Mr. Simmons, this is the house I'm gonna die in. And I'm like, well, that's only 30 years from now, you're pretty young. So those particular questions, but you know, hey, I get this a lot. You know, Aaron, I just got a contract. I'm a government contractor. I'm coming into this area. I'm only thinking about being here 5 to 7 years. That particular person might be looking for somewhere that says, maybe I want to buy in a high appreciation area because I'm not going to be here a long period of time. A retired person may or may not be looking for that. They're looking for stability. So they're saying, you know what, we're thinking we're going to be here 20 years for a while. We want a little bit more stability. So those are the questions. Also, for people that are starting families, school systems. So many times I have young families come in and say they don't even have any children yet, but they're already doing what? Pre-planning.
They're planning.
This is the school system that that we would like to be in. We're thinking about having children within the next 3 to 2 years, and we know this is where we're going to want to be because it's a strong school system and it has a good economic base. Those are questions that people should really be asking themselves. It's not just up to your mortgage advisor to advise you of that. The better equipped you are, the better we'll have placement for your mortgage and your agent that's helping you, your real estate agent that's helping you to find a property that's going to suit your particular needs.
I think that's important too, to think about where do you see yourself. You know, you always ask children, where do you see yourself when you grow up? Or one another, you know, where do you see yourself in 5 years or 10 years? Right. So you really have to do that pre-planning.
Yeah, life by design. Absolutely, absolutely. I agree with that. And so many times people react. So you have circumstances. It's easier when you plan things as opposed to just simply reacting to something. It's like, oh my gosh, now we need to move, as opposed to saying, we're already in the house. Now we're starting our family. So now we can expand and do these certain different things. So it's all just perspective, but that's a great point in reference to just helping people start planning on exactly what they want to do and seeing the future for their long-term success.
So when someone comes to you and they're asking about, you know, where is like the best, where are the best schools, you know, where are the best places, you know, to do ABC, what do you tell them?
Well, as a mortgage advisor, I'm not even legally allowed to do that. And typically, real estate agents are not supposed to do that as well. What they will tell a client is, you've got to do your own particular research, because that's something that's called steering. I know that term because I took that test and I did pass it. So that's so steering, because as advisors and professionals, we're not supposed to be steering clients in any particular way to give them some undue influence. So typically, people that know that are coming in asking those questions, you always want to talk to someone else outside your family, call your local police departments and things of that nature, and they can advise you on certain areas and crime rates and things of that nature. But as mortgage and real estate professionals, we should not be answering those questions, because that's not really our cup of tea.
Okay, and so when you want to know these things, so Mr. and Mrs. Google are going to kind of help
There's a lot of, there are statistics for statistics.
Right. Yeah. They're going to tell you, but let's say it's an area where everybody you know lives. And you say, well, you know what, it really does seem really nice. Yep. But then something has, you know, something has happened. And you're like, okay, this is where I really wanted to live. Right. But so I'm going to ask you, just with that, where are the best places to live in the USA?
Oh, in the USA? Yeah. For me, it's Miami. I think everybody wants to live on the beach. No, I'm being facetious when I say that. I'm being sarcastic. Those are just questions about lifestyle. It really just depends on lifestyle and what you do for a living and things of that nature. It's, listen, like my parents, they retired from New York and they went down to a southern state, and it's slow, but they love it. Some people love living in New York City. Some people love living in Chocolate City in DC. Some people want to live in California. It's all personal preference. Now, there are websites out there that tell people, hey, these are the best cities for up-and-coming professionals or millennials and things of that nature. Obviously, the Washington, D.C. area, I don't think I'd be incorrect in saying this, has a hugely strong job market. So any young person that's coming out of school that's in a certain particular industry, there's a really good chance that one of those jobs, you might find it in D.C. But in reference to, it's just really a personal preference.
Right, and that's a good point that you make. If you are in the DMV, you know, you have stability. For most people have stability.
Yeah, but that's what we want to call it. Yeah, absolutely.
Because when things were, you know, the market was going up and down, typically if you were in this area, people were still going out to eat. They were still going to the movies.
They were doing their thing. Yes,
People
they were doing their thing.
Doing stuff.
Yeah.
And everybody else is like, well, how are they doing it? But we have that market.
It's a bubble. It's the most incredible bubble. This in New York City. I wouldn't even say New York City, Manhattan itself. It's just one of the most incredible bubbles I've ever seen because it's so isolated from the part of the country. I mean, you think about it, you can drive, you can live in DC, and then you might drive a mile or maybe drive 60 minutes up the road to Delaware. It's a totally different economy. It's a totally different market. It's totally different everything because the jobs and the government drive this city. And then you have so many other subsectors. So we call these like little bedroom communities. Those are really huge now, and not just in Maryland, but in Virginia and in different parts. And what those bedroom communities are is that they're exactly what they sound like. People work at the Pentagon, but they got to drive 2 hours to go home and do what? Go to sleep. That's what they do. It's a bedroom community. But guess what? A lot of people can't live on Southwest Avenue or something in DC and pay $3 million to live in Georgetown. So that's why these communities were created, is because you have a workforce that can't necessarily afford to live in some of those cities, which makes our job more important, which is helping people find these programs to live in these particular places. There are so many commuters that I work with, people that live in parts of Baltimore that commute to DC or Prince George's County, and some of their drives are still really, really long. So we as mortgage advisors definitely have to help them find the right product that's going to help them with their mortgage payment and make sure they're putting their right amount of down payment, so that transition from wherever they're commuting from is going to be a smooth transition for themselves and their families as well.
And so you're actually looking at that. So let's say I live in, because I know people that live, you know, in Gainesville, and they commute to DC, that's at least 4 or 5 hours out of your day.
Can't get it back.
You can't get it back. It's just in traffic.
We ask questions. And the reason why, and some people that are probably watching this right now say, well, what's the correlation between asking people commute times and things of that nature? The reason why they ask is because it's gas, it's time, as you said, it's resources, and guess what they're always thinking about? Monthly payment. I've had clients, moms, fathers, sitting in there saying, babe, if we buy this house in this area, it's about maybe $35,000 more, but this is how much it's going to cost in gas. Aaron, can you run the numbers that says if we pay a little bit more, cuts back on the commute a little bit, how's this going to help myself and my family and cost-wise? Everything is relative when people are budgeting for a property, and these are things that people don't talk about. Your car is one of the most expensive things that you own because it costs you money if you have a car note to drive it, then you have to insure it, and then you have to put gas in it. They say the average American, it costs them about $900 a month to drive a car. Now think about that. Now you're just thinking you have a car note, but if you add up your insurance, your gas, and your maintenance, $900.
Wow. And so when someone comes to buy a home, this is what you have to look like.
We're sitting down, we're doing budgets and things, and we're just talking it out. And sometimes that's the great thing about the process, and I love what I do, is you start to get transparent with people. I've seen guys in there arguing with their girlfriends like, babe, you got to cut back on that Starbucks a little bit. You know, but these are real conversations. And I think that these are certain things that people don't think about necessarily when they're going into the process. It's not necessarily that we're trying to get too inquisitive, but we want to know what's going on. And these are questions that you ask. So if they're talking about a budget, I can then say, you know what? This particular sales price has this particular monthly payment, but this particular sales price has this particular monthly payment. So now you have enough information to make what? An educated decision, which is all we want the consumers to do. Have enough information to make an educated decision. So at the end of the day, as you mentioned earlier, they're comfortable with their decision, where they're living, and everything in that nature. But in order to do that, some families have to have all the information on the table.
Right, and who wants to give up like their Starbucks? Who wants to give up that?
I can give it up. Absolutely, yeah.
And so you were I'd never heard that term before, like the bedroom
community,
the bedroom community. So now we have these communities where you live, you have your Whole Foods and your Wegmans, and places where you can walk to. But what is that doing for? We know what it's doing for the economy, but what about for the individual person? So are we beginning to pay more for where we live because you have everything in your community, places where you can walk?
Yeah, absolutely. I can just talk as a consumer. I mean, local is all, I mean, you just think about it. There's places that you can live at in DC to where people pay a premium just to be able to walk to a bar. I mean, that's a true reality. So that's really something that we're getting to see. More people want communities that have amenities in them, but guess what? Real estate is real estate. So those costs and the cost to purchase the land and to do that, it just gets more expensive. So it's really, it's an interesting economy that we have. I would always say talk to a great licensed realtor that's out there, but in reference to the financing, we're always thinking about those things because communities that have those amenities, sometimes they might cost a little bit more, and our clients need to know by talking to their real estate agent, talking to their mortgage lender, how much this is actually going to cost them in the long run.
Right. And talk to us about escrow.
Sure, absolutely. So whenever I sit down with my clients, they like to laugh at me because when I describe escrow, I use props. I don't have my props in front of me. So escrow is basically, it's an account to where every single month that you pay your mortgage, you have to pay your taxes and insurance that are included in your mortgage payment. The reason why a bank has an escrow account set up is because if they don't, that means it's up to you to pay your tax bill. So I'll use a great example, real life. So my parents owned a home in New York, no longer live there anymore. My taxes on my property are much less, but in the property that they lived in Westchester County, New York, the taxes on that home today are about $15,000 per year.
Wow.
Now think about that. So if they were paying a mortgage, but their mortgage payment wasn't escrowed, what Westchester County would be sending them would be a bill twice a year. One for $7,500 and the other for $7,500. How many people not only had the means but the ability to write a check for that amount? Most people don't. It's the same for your homeowner's insurance. Your homeowner's insurance might cost you $1,500 to maybe $1,000 a year, depending on where they live. Well, if you don't have it escrowed into your mortgage payment, guess what happens? You have to write the check or make that payment however you want once a year. What the escrow account does is it protects the consumer and the bank, because what does the bank want? The banks definitely want you to have insurance, but they want you to make your tax payments on time. So every single month, you're throwing in that. When you make your mortgage payment, you're throwing a little bit of into the bucket. You're putting a little bit into the bucket and into the bucket. So when the year is over, your mortgage company already has the adequate amount of money to pay your taxes and to pay your insurance. I love escrow accounts. They always have to have a little bit in the reserve. The other great thing about an escrow account is that if the taxes go up on the property, they already have a little bit in the kitty in the background, so they can be able to pay it. Okay. Let's say you have a claim on your homeowner's insurance and your premium goes up. Guess what the homeowner's insurance is going to say? We need more money. I have an escrow account. I have a little bit of buffer. Just take it out of there. I don't have to worry about it. It's a wonderful thing. And it protects the bank and the consumer.
And the consumer. And the thing is, we know in this part of the world, in Prince George's County, I mean, your taxes are like $5,000, $6,000.
Depending on the property. I mean, it just depends on the property. But yeah, in this particular area, taxes are going to be high. Taxes are going to be high.
Right, because you go, I know people that live in D.C., oh, my tax is only like $1,000 or...
Where do you live?
Right, exactly. where
Let me know where you live so I can buy some property over there too. Absolutely.
Right.
Absolutely.
But that's something, I know that's kind of confusing to people to understand.
And understanding the concept, as I said, it's really every single month you have the stability of knowing that even when you get the bill, I know it's being paid by my mortgage company. And that is to protect the consumer and also the mortgage company, to make sure those taxes and insurance, so you're never going to have any lapses in insurance. And your taxes, you're never going to have a tax bill that hasn't been paid. Why? Because it's always included in your mortgage payment. Now, some people, they have the resources, depending on the type of loan you have, you can opt out to pay those taxes and insurance yourself. But that really just depends on you. But a lot of lenders want you to do an escrow. Absolutely.
Now, I didn't know you could do that.
Yeah,
you can
absolutely
opt out of that.
Yep, depending on your loan type. FHA loans, those are government sanctioned loans, you have to escrow. But on certain conventional loan products, you can opt out not to escrow, but remember, those taxes and insurance, those are your responsibility.
Right. So are you saving more money doing one or the other?
It's to each his own. When the bill comes due, you either pay it or you don't.
Right.
I mean, it's just, now some financial advisors might come sit in this chair and say, well, if you're not paying that monthly and you're reinvesting the money here and there, so there might be an opportunity, but the bill's still going to come due. A lot of the customers just want to do an escrow account and have it over and done with. Some people might be a little bit more savvy and do something different, so it's to each his own.
And so when we're looking at that, so when I go to purchase my home, that seems to be a lot of money in the kitty.
Yes, yes. Lenders are only allowed to keep a certain amount of money in the escrow account. So when you decide to refinance your loan or something of that nature, take advantage of some of these great interest rates that are out there, they can't keep your money. So when your new mortgage company starts their new escrow account, whatever's left over, they have to actually refund to you in the form of a check. So they're never, and this is government sanctioned, they're never allowed to keep over a certain amount of money in the escrow account legally. And that's to protect themselves, because what you don't want banks doing is lending that money out in your escrow account on it. So it's just protecting consumers as well.
And that's interesting, because that's something you really need to know and to understand.
Absolutely, it's a fundamental part of the process.
Right, and so when we're talking about like those things you have to know, but when it's time for me to buy my home, do I just automatically say, this is like, do you know exactly how much you're going to need for that, or it's just depending on the home that you're buying?
Oh, you mean in reference to maybe down payment?
Right.
Okay,
right,
so down payment, it really just depends on the product. So for example, there's FHA, which is a great starter product for, I don't care if you're a young person or older person, it has a 3.5% down payment. I'm not sure, you're a very young woman, so I'm not sure if you remember this, but there was a time to where the rumor was, you've got to have 20% down to buy a house.
Right.
Now, obviously with inflation and incomes not catching up with inflation, that has become a lot more difficult. So now they had to create some more products that are available. So FHA only requires a 3.5% down payment. So I like to use real even numbers so the public can just think about it. So if someone wants to buy a $100,000 house, that's $3,500.
Right. Right.
That's very affordable. $200,000, you're talking about anywhere between $6,000 to $7,000 and onwards and so forth and so on. If you're a veteran, this is one thing, because we're in an area that has a lot of veterans available, so people that served in our great military. You have VA home loans. Those loans have 100% financing for our veterans if they meet certain eligibility. That's fantastic. You have conventional loans that are available to where you have a 3% down, and then you also have grant programs such as Maryland Mortgage Program. You have USDA loans, which is United States Department of Agriculture. So if you live in a rural area, you can do 100% financing. So there's so many programs out there for people. So there you have options available, but I always tell clients, cash is king. Right. So you always want to have a little bit of skin in the game. So you can bring a little bit of cash to the table. It's always, in a lot of cases, going to help you get better terms on your mortgage.
Thank you so much, Aaron, and let people know how they can get in contact with you.
Okay, I'm Aaron Simmons. You can go to my website, www.fhmtg.com/Aaron-Simmons. You can find me on LinkedIn under Aaron Simmons with First Heritage Mortgage, and also on Facebook, just Google Aaron Simmons, and I'll be glad to help you. And I really appreciate the opportunity. It was a real fun discussion, and I'd like to come back one day.
You can, and I mean, I've just learned a lot. So thank you, Aaron Simmons, for being on the show, and we'll see you next time.